Okay, welcome to today's class. We continue with our FR introduction with special emphasis on consolidated statement of financial position. In our previous class, we discussed pre-acquisition retained earnings and post-acquisition retained earnings. And in that class, I did explain that pre-acquisition retained earnings is that earnings that a company had before they were acquired. You understand? Now, post-acquisition retained earning is that earning that a company, a subsidiary company has after it was acquired. Computationally, if you want to calculate your post-acquisition retained earning, you will say post-acquisition is now equal to retained earning minus pre-acquisition retained earning. In every question, they will give you pre-acquisition retained earning, but they will never give you post-acquisition retained earning. So you have to find it yourself. What do? The retained earning in the statement of financial position minus the pre-acquisition retained earning in the additional information will give you post-acquisition retained earning. Although sometimes you need to adjust it, but as we progress, I will teach you how that is done. So I would like us to now look at how consolidated retained earnings is computed. This is actually the retained earnings of the parent company plus the share of the parent company's post-acquisition retained earning of the subsidiary. Look at the format. This format was provided by IFRS 10. Parent company, the PC there means parent company. So parent company retained earnings, you bring the value. Now share of subsidiaries share of PC's post-acquisition retained earning. You understand? So the PC's post-acquisition retained earning of the subsidiary. So the percentage, if it is 70% that the parent company has in the subsidiary, you multiply it by the post-acquisition retained earning. So that will give you consolidated retained earning. Now, so I gave a note on this. You read that up by yourself. Then we'll now take a question to appreciate what we just discussed. P acquired 100% of the share capital of S on 1st January 20X1 for 200,000. The balance on the retained earnings account of X was 80,000. So this is a pre-acquisition retained earning. Now remember, I did tell you they will always give you pre-acquisition retained earning. So as at January that P acquired S, the retained earning in the books of account was 80,000 naira at this date. Now we continue. The statements of financial position P and S as at 31st December 20S1 were as follows. So we have P, S, non-current assets. Now property, plant and equipment, we have the values. Investment in S, we have the value. Current assets, we have the values. Now equity, share capital, we have the value. Share premium, we have the value. Retained earnings, we have the values. Now you can see that the retained earnings of the subsidiary is 140,000. So how would you now get your post-acquisition retained earning? You will now say 140,000 minus the pre-acquisition of 80,000. That will give you post-acquisition retained earning. Now that is why we took this question, so that you can understand what we talk about. Now the first thing you do is workings. You leave the solution. How is the workings done? This is the workings. The first thing you prepare is net asset summary. Net asset summary is actually a working that we do to ascertain the net assets of the subsidiary at date of acquisition and date of consolidation. Now, date of consolidation is 31st December 20X1. Date of acquisition is 1st January 20X1. So the share capital, which is given in the question, is 30,000 naira, will be the same at both dates. The share premium, which is 90,000, will be the same at both dates. So we'll go back, look at it. 30,000, 30,000, 90,000, 90,000, share capital, share premium. Hope that is understood. Now, the retained earning at date of consolidation is 140. This retained earning will always be the retained earnings in the statement of financial position, 140. Now, the at date of acquisition, the retained earning will be the pre-acquisition retained earning. Now, the retained earning as a date of consolidation minus the retained earning at a date of acquisition will now give you post-acquisition retained earnings. I hope that makes sense to you. So that's done, you add up. So the at date of acquisition, the value. No problem. So you would see that we have our values. You understand? Good. So the date of acquisition, the net assets is 200,000. So you compute your consolidated retained earnings. It's another workings you must do. I've already given you the format. The retained earnings of the parent company is how much? Is 470,000. Look at it. Retained earnings. The first one is parent. The second one is subsidiary. Is 470. So you now bring it in 470. Now, the parent company will take percentage of the post-acquisition. The post-acquisition is 60,000. Look at it. So the parent company will take its percentage. So how many percent does this P has in S? Is 100%. So 100% times 60,000 will give you 60,000. So when you add all this, it will now give you 530,000 naira. I hope that is clear. Good. So we'll now continue. So that is that about that. So we will go back and now consolidate, using the rules of consolidation. You add the PE of the parent company and the subsidiary to give you this. You add the current assets of the parent company and the subsidiary to give you this. Recall that the cost of investment wouldn't come in. You must take note of that. Then we'll now move down to equity. In equity, only the share capital and share premium of the parent company would come in, which is 150,000 and 280,000 naira. So we have share premium. So for share premium, we have parent company only. So we bring in now. We now bring in our consolidated retained earning, which we did workings on. And when we did that workings, the value was 530,000 naira. You understand? Good. So this is how we got our value. So we add up this to give you 960. You bring in the current liabilities of the parent and the subsidiary and the balance. So it's simple. Now we'll move a step further by looking at what goodwill is. Now, goodwill is actually arises as a result of a company acquiring another company and paying an amount either higher or less than the net assets of the company. So when goodwill normally arises when we incur an expenses that is higher or lesser than what we are meant to pay. You understand? So the format for computing goodwill was provided by IFRS 3. The format is consideration transferred, which is cost of investment, minus non-controlling interest. Add non-controlling interest. It will give you this value. Then you now bring less your net assets. You now have positive goodwill. So this is the format of computing your goodwill, and you must have this format at the back of your mind. So we will take a question to look at this. We have two types of goodwill anyway. You read that up. So we now take this question. P acquired 100%. See, we are still on 100%. And when a company is acquiring 100%, there is no non-controlling interest. Good. But we will, in our next class, we'll be looking at non-controlling interest and some adjustments. Are you there? So let's continue where there is no non-controlling interest. I hope that is cleared. Good. So we now have P acquired 100% of S on 1st January 20X1 for 230,000 naira. The retained earnings of S were 100,000 at that date. You see, as I told you earlier on, the question would always, at all time, give you the what? The pre-acquisition retained earnings. Now, you have to find your post-acquisition retained earning. That is your work. And I have told you how to do that. Is that understood? Good. We'll continue. So now these are the financial position. We have investment in S. We have other assets. We have equity, share capital, share premium retained, and we have current liabilities. So we have our values. Now, you have to do workings. You are required to consolidate. So the first working you do, as I told you, is to determine your net assets. You prepare your net asset summary. Your net asset summary will have 3 columns: dates of consolidation, dates of acquisition, and post-acquisition retained earnings. So we have share capital. So share capital, we have the values. Now share capital of the will be the same at date of consolidation and date of acquisition. Share premium will be the same too. Let's go and confirm that. In the question, the share capital of the subsidiary, which is the second column, is 50 and the share premium is 20. So we come down and look at it. It is brought here. I hope you can see that. Good. Now, we'll bring in the retained earning. The retained earning as a date of consolidation will be that one that is in the statement of financial position. That is what it will be. Now, the retained earning as a date of acquisition will be the one that was given to you in the additional information, which is this 100,000 naira. Hope you can say it at that date. Good. So the difference will now give you post-acquisition retained earning, which is 25,000 naira. Is that clear? Good. Now, we'll now come and do working number 2, consolidated retained earnings. For consolidated retained earnings, it is simple. Okay, sorry, we'll calculate our goodwill. The first thing that will come in is consideration transferred. Consideration transfer is the cost of investment of P in S, and it was given to us. You go and look for it. Investment in S at cost 230,000. Are you there? Look at it also. P acquired 100% of S on 1st January 20X1 for 230,000. That is cost of investment. So you bring it in immediately. Now, non-controlling interest will be nil. I have already told you. Why is it nil? Because P acquired all the shares. So there is nothing like non-controlling interest here. So it's only controlling interest that is existing. So it is new. You add up, you have 230. You bring in the net asset at date of acquisition, which is 170. You might not see you have 60,000. This is positive goodwill, which is an asset. Then the last workings, you see our number of workings is increasing. Now we have 3 workings. The last working, which is the third working, is consolidated retained earning, which is you bring in the PC, the parent company's retained earnings, which is 440,000. Look at it here, 440,000. You can say the first column, 440,000 retained earnings. Now you bring that in. You now bring in the post-acquisition retained earnings, and the post-acquisition retained earnings is 25,000. Multiplied by 100%, you have 25,000. So you add up, you have 465,000. So you now consolidate. You go back. Consolidation is simple. You bring in goodwill. That's the first thing you bring in. Goodwill. You now bring in other assets. Other assets will now be the other assets of the parent company plus other assets of the subsidiary. You add up, you have 870. You now bring in your ordinary share, and your share premium will be that of the parent company only. You have this here. You now bring your workings for consolidated retained earnings here. You have this value. Then you now come here and bring in your current liabilities, which is that of the holding company and the subsidiary. Added together, you can see 60-40 will give you 100. If you add up, it will balance. So that is how it is. So we will continue in our next class by looking at how non-controlling interest is treated. After I explained, I'll look at some little workings also, so you can have a good understanding of consolidation. Thank you for attending, and do have a nice night.